All right, family, I got the perfect investing plan for somebody that's looking to build their portfolio out, right, with a mixture of stocks and ETF. So I got a question. That's why I be telling y'all to comment in the questions below, because we want to take those questions and help you out on the whiteboard and draw it out so you can see it. So the question we got today was, Trap, if I'm an investor, could you help me create a portfolio based on ETFs and individual stocks because I'm a moderate, aggressive investor? So today we're going to talk about that. We're going to break that down for you in the blueprint. So get your pen, get your pad, and get ready to take notes, man. What's good, family? It's your boy, the Wall Street Trapper, man. My goal is to help you build your portfolios and build wealth one share at a time so that you can buy back your freedom, man. What I want you to do today is, man, I want you to listen to what we're about to put here, yo. We're going to break this down for you in a way that anybody can understand, right? But I want you to like and I want you to subscribe and I want you to share this out. But lastly, while you watching these posts, while you watching these videos, talk to us in the chat so we can know what's on your mind so that we can help you on this whiteboard. Right? All right, so somebody asked me, man, I'm gonna put this in my pocket now. Somebody asked me, Trap, how do I build out a portfolio with stocks and ETFs if I'm a moderately aggressive investor, right? And that's a great question. So I wanna thank you for that, right? And what I wanna do is, first of all, you have to have a blueprint. You have to have a game plan when it comes to investing. And one of the things I want you to focus on too is steady growing your money. And I want you to focus on time, not timing. Right? And what I mean by that is I want you to focus on not trying to pick the right stock today, right? I want you to focus on what gives me steady growth in my money. I want you to think about something. The stock market goes up 75% of the time. So just in the last 20 years, you've 6-7x your money just by being in the market. Now, I do believe personally that we don't buy companies and forget about them. Right? We don't buy companies and hold them for 20 years. Like, I don't believe that. I believe that we should, every year, a company should earn its place in our portfolio, and we should have a 1, 3, 5 year vision on the companies that we invest in. How is it doing this year? If nothing changes in the market, I'm looking at earnings calls so I can pay attention to what's happening. 3 years, I'm looking at what did it do. 5 years, I'm looking at what did it do. Do I got to take it out? Do I put it in? Remember, you are a portfolio manager. Right? I don't care what nobody say. And listen, I'm going to say something. The internet about to go crazy on YouTube because it's about to go against everything Warren Buffett said. It's about to go against everything Charlie Munger said. It's about to go against everything Jack Bogle said. This is about to go against everything that every other YouTube channel has said. I don't think you should just buy index funds and chill. That's right. You don't got to wait 50, 30, 20 years to become a millionaire. Anybody can become a millionaire in 5 to 7 years. I've already laid that blueprint out. Go check out the older videos. But I want you to understand this, yo. You don't got to wait till you 70 years old, 80 years old to be a millionaire. The market printing money every day. What I need you to do is I need you to just pick up that aggression a little bit. I want you to stop being so conservative because you're scared to do what? Put your money in the market. And I want you to look at the market from a perspective of it's a money printing machine. We just got to navigate the ups and downs of the market so that we can do what? Print money too, right? And so that's what I be wanting to do. That's what I be wanting to empower y'all with. So first thing we're going to focus on again is we're going to focus on steady growth and we're going to focus on time, not timing. Meaning, what is my outlook? That 1 year, 3 year, 5 year, what is my goal to be a millionaire, right? So here's what I want to do. Let's break it down. So the first thing is, if you that, like, I want you to focus on, if you say, Trap, I'm moderate. So in the moderation, I want you to focus on ETFs, right? I want you to put 50% of the portfolio in ETFs. And here's how we can break that down. Right? We can break it down with like AIQ, which is an artificial intelligence ETF, right? We could go QQQ, which is the NASDAQ ETF, right? We can go SMH, semiconductor ETF, right? We can go, I like XLF, why? Banking. But then what you can do is you say, all right, Trap, I found some ETF that I like, right? You can go, it's so many ways. You can go IWV, growth, right? You can go so many ways with this ETFs, right? Now, the dope thing you can do is if you buy ETFs, so we're gonna go 50% ETFs. Why we go 50% ETFs, Trap? Because you say you're moderately aggressive, which means you're not over the top. Meaning, Trap, I'm willing to take on a little aggression, but I ain't all the way out there, Trap. Like, I want to just take on a little aggression. I can take a little turbulence, right? I'm good with that. And so what I want you to do is, I'm just using these as examples. Remember, I got posts in here on the page about ETFs because I know a lot of people like that, right? In Trapping Tuesdays, we do an ETF Thursday. In my group, Trappers Anonymous, we do an ETF Thursday every Thursday, right? And what you can do is say, okay, Trap, this is 50% of my portfolio. I like that, Trap. Like, because what the ETF gonna do is it's gonna give you balance. It's not gonna overextend you. But what it is, like this, artificial intelligence, this technology, this is semiconductors, this is financial, this is growth, right? There's so many ways you can play ETF because the ETF is going to concentrate on one like industry, right? And that's real good. Now watch this. Here's what I really like about this. So the next thing we're going to do is go 30% growth. So watch this. You can look for a growth ETF, right? An ETF that's focused on growth, which is all of these except for this one. That got growth in it, right? So we can go inside of these ETFs. Now, what I will say, you know me, I don't want you to have a portfolio of no more than 10 positions, 10 to 15. I'll give you that, right? 10 to 15 positions. So if you're going to do 10 to 15 positions, you're going to go half of the portfolio in ETFs. Let me say this right quick. If you're going to go half the portfolio in ETFs, you got to make sure the ETFs not cross, like hitting each other, right? Like if you're going to go, like if you go SMH QQQ, right? That's okay, but I don't want you to go SMH SOXX. You know what I'm saying? I mean, yeah, I don't want you to do those two, right? Or if you went, I'm just using for example, you go VOO, I don't want you to go SPY, right? Because they're the same. Like if you go VOO, I don't want you to go VTI. You know why? Because it's the same thing. It's 70% of the same thing. So I want you to be mindful of that. Now, when you're watching the ETFs, you got to always look at the top 5 positions. And the reason why, because a lot of times in the ETF, the top 5 to top 10 positions, make sure they differentiate in the other ones because that's how you overlapping. And now you're in the same ETF twice, right? So pay attention to that, right? That's going to help. So then I want you to go 30% growth. Watch this. You go inside the ETF and you say, all right, Trap, if I got 10 stocks, I got 5 ETFs, they different. That means I got 5 stocks left, Trap. Guess what? You can left there and say, hey, I'm going to go 2 more stocks that's individual that I get from somewhat that I get out of these. Because here's what we're going to do. Here's what we're going to do. I want you to go not 30%. I want you to go 30% individual stocks. So that means you'll take 3 of them. Right? 30% individual stocks. So now you're taking 1 from each one. Now here's what I would do right here. If you in growth, you can be growth in so many different ways. Let's say you in the financials. Let's say you in artificial intelligence, right? Let's say you go with, one of the artificial intelligence stocks. But then let's say you was in financials. I would say go like a financial stock that has growth, or if you in XLF, I will go to a healthcare stock that has growth. I wouldn't be in the same 2 stocks in the same 2 industries in the same ETF that we have. And the reason behind that is this. You don't want all your positions in the same field. Why? Because even though the ETF is going to give you balance, if you now pick your 3 stocks in the same ones, now you put everything in one thing. So when the market fall, the whole ETF fall, the whole portfolio down. You want to try to mix that up a little bit. So make sure you mixing it up, right? So if you in SMH, yep, you go get NVIDIA. If you in XLF, you go get Goldman Sachs, right? Or Berkshire, something like that. You want to be able to mix that up in a way where you got exposure to a lot. But the dope part about it is because you only got 10 or you got 15, half of it is in the ETF. That gives you balance. Then the other 30% is in individual stocks. So now you can still experience the growth part of it. All right, now watch me here. Watch me here. Then we're going to go 20%. Watch this. We're going to go 20% divs. So watch his, this the boring companies. Watch this. This your Costco. This your Walmart. This your Williams and Sonoma. Right? Why do you pick them, Trap? Why you ain't pick Pepsi? Why you ain't pick Coca-Cola? Because them companies is boring. Well, not boring from a perspective of the company model. The way they return is boring. Watch this. Costco be whooping the market every rip. Walmart whooping the market every rip. Williams and Sonoma whooping the market every rip. Well, why did I say that? Well, because not only are they growing the dividends, they're still outperforming the market from a stock perspective. So you get safety in the dividend, you get companies that's growing the dividend, and you still get companies that's outperforming or at least close to what the market doing. So now you got your ETFs, you got your individual stocks, and then you got companies that's growing the dividend and beating the market. Now you have found a portfolio of 10, 15 companies that's actually performing for you and making you money. And what you've done now is you've built out a solid portfolio. Now, all you need to do now, get in the options market, let the options market feed this, you on it. So now every time this pull back, give you a dip bigger than 5%, guess what you're doing? Hot insert, hot ATM. Because all this thing gonna do for you is print money, and guess what? It's gonna stick to our rules. We're gonna focus on steady growth with these companies. That's what those did. It's gonna focus on time in the market, not time in the market. You're gonna get your 50% ETFs. You're gonna get your 30% stocks that's value on growth. You're gonna get the 20% dividend on that boy. You feel me? So it's your boy, the Wallstreet Chapman, man. I hope that really helped somebody out just now, right? When it comes to building it out, ask your questions in the comments. We're gonna literally extract them questions and we're gonna just put it on a whiteboard for you so you can see exactly what it is that you need to see, man. Nobody else not doing that for you. Listen, man, I want you to check us out each and every Tuesday at 7 p.m. Eastern on the Wall Street Looks Like Us Now network. I want you to understand that's not me in the chat telling you about Bitcoin and WhatsApp and all that. That's some scammers don't fall for because I can't help you, man. It's your boy, the Wall Street Chapman, man. I love you. I appreciate y'all.